All the silver people came out and said it's silver that broke the system. They shut all of this down because silver is out of control. And that is a reasonable possibility. We've got very, very low stocks in London and so on. The supply-demand fundamentals for all of this is, so it was blamed on a cooling issue, that this data center had exceeded its capacity to cool. Silver that caused this? I don't think so. But like I said, it doesn't matter. But all of the silver people came out and immediately attributed it to silver breaking the system instead of the system.
A sudden shutdown in global derivatives trading sent shockwaves through the precious metals community, igniting debate over whether silver had finally pushed the financial system past its breaking point. Mike Maloney explains that as soon as the disruption occurred, silver advocates immediately claimed victory, arguing that low inventories and an explosive breakout had overwhelmed the system. While he agrees that silver's fundamentals are exceptionally tight, especially with historically low stocks in London. Whether the cause was technical or market-driven, Maloney stresses that it ultimately doesn't matter. What matters is that the global financial plumbing is overloaded, outdated, and cracking under modern data demands. Mike Maloney highlights analysts who confirmed that nearly 90% of derivatives trading halted not due to manipulation or cyberattacks but because the infrastructure couldn't handle the load. He draws attention to a key thread arguing that silver hit circuit breakers because confidence in currency is eroding and true price signals are returning. According to this perspective, silver as the underestimated monetary metal is simply leading the move. Mike Maloney then turns to the series of margin hikes on gold and silver throughout recent months, a pattern strikingly like the tactics used in the 1970s bull market to slow rising prices. Despite these interventions, he notes that silver continues to find strong support on its 50-day moving average, working off overbought conditions before breaking higher. With momentum restored and technicals aligned, Maloney suggests the setup remains powerful, showing that the real vulnerability lies not in silver's strength but in the fragility of the financial system trying to contain it. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
All the silver people came out and said it's silver that broke the system. They shut all of this down because silver is out of control. And that is a reasonable possibility. We've got very, very low stocks in London and so on. The supply-demand fundamentals for all of this is, so it was blamed on a cooling issue, that this data center had exceeded its capacity to cool. Now, there's some good evidence that may be the truth, but I'm going to show you later that it does not matter. But this was an exciting day, and there's some other things. Silver has basically done a breakout, so you need to watch this to the end. Anyway, we need to cool off the silver market, reposition to avoid silver exploding higher. So this is the translation, a cooling issue. Actually, I'm not sure if it was silver that caused this. I don't think so. But like I said, it doesn't matter. But all of the silver people came out and immediately attributed it to silver breaking the system instead of the system just breaking. Anyway, Gray Rabbit Finance, Hansa Czerny, and he could be right. Hansa has had some great information lately. Shanaka says that it wasn't the silver breaking the market. It wasn't a cyber attack. It was basically that. And by the way, 90% of global derivatives trading stopped. Not hacked, not manipulated. The cooling system failed in a single data center in Illinois. And he goes into the amount of power that this is sucking, and that these servers, this data center, was actually designed for 2015 capacity, and it really hasn't changed. And here it is, 2025, and the amount of data going and processing going through this far exceeds it. But this is the tweet that I would like you to read. It is long. We will try to include the link at the end or down in the notes below. But silver's bull run hit a CME circuit breaker, but the cycle won't stop. And basically, Ben Rickert is putting out the evidence here of why this cycle won't stop. And the great part is down at the end here. He says, money is unraveling. He means currency here. Money is unraveling. Confidence is eroding. Price signals are returning. And silver, which is money, is the underestimated monetary metal. Monetary means money is leading the way. The bull run didn't pause. The exchange did. That tells you everything you need to know about where this cycle is going. And he has nailed it here. Please read his tweet. It's long, but it's not that long. It's going to take you 2 minutes. So now they haven't even started the shenanigans yet this month that they were doing last month and the month before. So this is from Nick Laird at Gold Charts R Us. On 9/13, gold margins were raised by 6.7%. If you remember back then, gold was moving first. Silver wasn't taking off yet. It wasn't breaking into brand new all-time highs like it is now. So that was 9/13. Then 9/25, they raised gold margins by 6.3% and silver by 6.7%. And then 10/9, they raised gold margins by 5.9% and silver margins by another 9.4%. Then 10/16, just a few days later, a week later, they raised gold by another 5.6% and silver by another 8.6%. And then on 10/23, gold and silver by another 5.3%. They haven't even started this shenanigans yet. You're going to want to hang on until the end here because I'm going to show you how this reflects on the 70s bull market. Now, in looking at the price here, we are up at some amazing territory here. We're right near the highs while this is being recorded. But if you look at this, the orange line is the 50-day moving average, and look at the support that it has given this all the way across. The green line is the 10-day moving average, and the 10-day moving average, you'll notice on uptrends like this, that it gives great support on uptrends, and when it breaks it, we're in a little pullback. Well, it's given great support now every once in a while. Gold and silver and almost everything else in the markets needs to come back and visit its 200-day moving. But that is a much more rare event. So we've visited the 50-day 3 times here. We've visited the 50-day. It's worked off its overbought condition. So now it's sort of free to run. And it looks like it is.
Mike Maloney underscores that the real focus shouldn't be on short-term noise, whether a data center overheated or silver momentarily disrupted the market. While he doubts silver caused the outage, he leaves room for uncertainty, emphasizing that what truly matters is the long-term structure unfolding in precious metals. He revisits the massive 45-year cup and handle pattern he identified months earlier, now fully confirmed with a breakout. This pattern mirrors the setup seen in the late 1970s bull market, where silver surged from around $6 at the start of 1979 to over $50 intraday by January 1980. Back then, authorities repeatedly raised margin requirements, imposed position limits, and ultimately enforced a liquidation-only rule to stop the runaway market in action that forced selling and triggered a simultaneous peak in both gold and silver. Mike Maloney explains that breaking silver was an indirect way to shock gold traders, since both markets were tightly connected. Once silver was restricted, gold peaked the same day, helping stabilize the dollar. Now, with today's breakout arriving at almost the same moment on the calendar as 1979, he suggests that history may be repeating in a striking way. If this pattern holds, he believes silver could see extremely high prices by early next year, especially when factoring in decades of currency expansion, perhaps enough to justify moving the decimal point 1 place higher. Let's get back to the interview.
And then the main point, though, isn't to pay attention to all of the short-term noise. Yes, some servers probably overheated. It probably wasn't silver breaking the market, but I don't know that. I can't confirm it. Maybe it was silver, and maybe this is all an excuse. I doubt it. But because they didn't pull the other shenanigans yet. I'll get to some even greater shenanigans that they can pull when I do a comparison of today's market to the 1970s. But keep an eye on the big picture. In September, I drew you these charts. This is the big 45-year cup and handle pattern that I believe I was the first one to identify, but it hadn't broken this yet and confirmed that we were off to the races. Here it is in linear format instead of log, just to show. This is the big old beer stein. Cheers. But in keeping an eye on the big picture, I want to compare this to the 70s bull market. So here you've got 1979, the last year of the 70s bull market, because it ended January 18th, 1980. So this is to January 19th, 1980. And it was 49.45, all of these because Stock Charts doesn't have the intraday data, but that was the close. It actually reached 52.50 intraday. But if you look at what's going on here, it was rising and rising and rising. Now the Hunt brothers had a major concentration in the silver market, and it is my total belief that because the Federal Reserve was involved in some of these decisions, Paul Volcker, but it is my belief that that gold was in a runaway, and that threatens the survival of the dollar. The dollar had only been a fiat currency for 8.5 years, and they were trying to get gold under control. But gold is a huge market. It takes a lot. Now, in the silver market, it was I don't know the exact size back then, but it was around 1/300th of the size of the gold market, something like that. There are times, though, where it's only like 1/30th of the gold market instead of 1/300th. It was much easier to control. And then the Hunt brothers had a major concentration. So they had basically a scapegoat, and they had somebody that had a major concentrated position that they could break if they kept on changing the rules. So they went up and they kept on increasing margin requirements and increasing margin requirements. But still, it did a breakout. So here we have roughly $6 at the beginning of 79. And then we've got 1750, higher than 1750 here in September. And then at the end of November, just like today, this is, what was that, 43 years ago, something like that. It did a breakout and started a run, and they would increase margin requirements and increase margin requirements. And then they put in position limits. A futures contract is 5,000 ounces. They put in a position, you could only hold so many futures contracts. And that caused major players that have very large positions to have to dump a whole bunch of their silver, but that didn't stop it. And it kept on running and running and running. And then they finally had to put in a rule, liquidation orders only. The people that make the rules of the game were short silver, and something had to be done. But also, gold was in a runaway, and we came very close to losing the US dollar back in January of 1980. And so if you can crush the silver, a whole bunch of people that trade silver also trade gold. All of the brokers that do gold and silver trades do both. In the commodities exchange back then, in Chicago, in the Chicago Mercantile Exchange, there were pits, circles of guys, doing hand signals and screaming at one another and doing all of this trading. And the silver pit is right next to the gold pit. And don't you think, like on a bathroom break or something, they talk to each other? And don't you think that The gold guys go, wow, if they can do that to silver, we're next. And gold and silver peaked on the same day. They put in a rule called liquidation orders only on silver, and that is a rule that says until this rule is lifted, the price of silver can only go down. It means that you can close out existing futures contracts, but you cannot buy a new futures contracts. If there are no buyers and all you've got is sellers closing out old deals, that means the price has to fall, period. And so this is a rule that says until this rule is lifted, the price must fall. And don't you think the gold traders go, oh my God, we're next. And they all said, sell. And that's when gold and silver peaked and the dollar survived. Now, history is repeating, and it is interesting that this breakout is coming on approximately the same day, 40 some years later, as it did back in November of 79. And we may be off to the races. So it's possible by next January we could be seeing some very, very high prices in silver. But to account for the expansion of the currency supply, to account for the growth in GDP, perhaps we need to move this decimal one place to the right.
The evidence now points toward a moment where temporary noise, technical outages, rumors, and day-to-day volatility fades in importance compared to the structural forces driving this bull phase. The long-term pattern mirrors the late 1970s with striking accuracy, revealing how repeated margin hikes, position limits, and even liquidation-only rules were once deployed to tame a market that was threatening the stability of the dollar. Despite every intervention, silver still surged into a historic breakout. Today's price behavior and timing echo that same setup, suggesting that the current move is not a random spike but part of a much larger cycle. If this trajectory continues and adjusts for decades of monetary expansion, the coming months could carry silver to levels far beyond previous highs, signaling a powerful shift in both market dynamics and broader confidence in currency. What early signs should investors watch for that indicate regulators may step in to slow a sharp silver rally? So, stay tuned for clear, data-driven insights into the financial system. Don't forget to like and subscribe so you never miss our weekly updates. Thank you for your continued support, and we hope you enjoy the video.